Good morning, everyone. We can't predict the future, but we can definitely prepare our business to face the unforeseen challenges. A lot of businesses had to either change the way they work or shut down due to this fast-changing environment, and also be accelerated due to the pandemic. Now, this brings us to a very important question. Can we future-proof our business? Can we increase the chances of business survival? This kicks off the second session panel discussion of FIMMAC Day 2, Future-Proofing the Industry. I have with me today for this session, Jerry, CEO of abrdn, Islamic Malaysia, Encik Ahmed Muzni, CEO of Maybank Islamic Asset Management, and Mr. Bryan Zeng, General Manager of FA Advisory Sdn Berhad. Gentlemen, thank you for being here today and to share your thoughts of the new normal. The view of change is turning on our industry. The industry is in the midst of significant change. There's a new generation of investors whose expectation and preference have been shaped by new technologies and by their living through the last financial crisis and recently the pandemic, have brought new standards to the industry in terms of how advice and investment products are being delivered. Also, shifting demographics with the aging of advisors and an upcoming transfer of wealth from baby boomers to their children will upset many established advisor-client relationships and create opportunities for new firms to grow market share at the extent of incumbent firms. For today's session, we will center on some of these sources of disruption in the investment management industry today. So, to start the ball rolling, Jerry, for asset managers, there are new competitive patterns, new firms and new business models, as well as renewed commitment by incumbent firms will drive higher intensity of competition for the same clients and the same assets. Where do you see the investment management industry, both locally and globally, is at now? Jerry.
Thank you, Matt. Yeah, certainly, the fund management industry is always under flux, but I think that change has accelerated recently. And the word that I just wanted to point out a few things that are really different today from how they might have been, say, at the turn of the century. Because now we are most definitely in what they might call the exponential age. When I say exponential, I mean sort of dramatic changes. I was listening to the radio the other day and somebody mentioned that 250 years ago, if somebody was asked how he might be able to get around quicker, he would say, well, I just need a faster horse. Then came the invention of the internal combustion engine and everything dramatically changed. So this exponential stage has been going on for a long time. But really, I suppose the advent of social media, faster communication by internet, by Facebook, by Twitter, by WhatsApp, even Donald Trump, I think, is setting up his own communications or media company that has sort of exploded as what they call a special acquisition company. But you have to have the ear of people, but it's all happening so fast. It makes forecasting the future extremely difficult, particularly for fund managers because of this change in and speeding up of every process. Certainly, back in the day, not that long ago, I suppose, really only about 15 years ago, fund managers would be able to go to clients, whether they're retail, wholesale, institutional, and say, look, we're really good at this. This is what we're really good at. Do you want some of it? And the client would decide whether to accept that offer. Nowadays, it has to be driven by the client. I mean, it's got to be a good thing, but have to be aware that the client is at the center of everything we do. And therefore, you have to say, what do you want? And we might have to tailor make or have a bespoke product that you want. I mean, that's a key difference, I'd say. And the other thing is, I suppose, since the turn of the century, we and the world has realized that climate change is not just something people talk about. It's permanent, or it's, if we carry on as we are, we're not going to have much to hand over to our kids. So really, when you invest for clients, we play a very important role in making sure that we adapt to the change in climate. And for many companies, and Aberdeen's a sort of bottom-up fund manager, it is important to know whether a company has considered climate-related changes and what effect it will have on their business, what they would do were those changes to happen, and how they can take advantage of the opportunities offered by climate change, because the rules are going to change, everything's going to change. So that is as important as really the company's business model, price-earnings ratio, balance sheet issues, and the governance of the company. All these things now, environmental and social issues, as we in Malaysia learned to our expense sometimes in the manufactured rubber gloves industry and the palm oil industry, are as important and must be taken heed of that weren't there before, really. The other thing is that it used to be a fairly simple game. I think a long, long time ago when I was a kid, it was really just bonds. And then you had a choice of investing in bonds or equities. But now there's been this massive proliferation of other products, from in the private markets. And in private markets, you're talking about private equity, which is not liquid. And everybody talks about the illiquidity premium. Well, when things go wrong, it becomes an illiquidity discount, I would warn you. But nevertheless, a lot of people decide they don't need to go to public markets to get funding for things. And there's so much money washing around. That's growing very fast. Private debt. Private assets or real estate are extremely important as well, and a means of diversification for investors in different countries. You've also got, computers and quantitative investing, which turns out to be cheaper. Computers are cheaper to pay than human beings, and passive funds that reflect an index, factor investing are things that you can't pretend is not there. These are options that give you exposure to various different asset classes without you having to pay so much. So all these things, other alternative investments, are certainly things that are there. And I think you have a choice. You either offer all these products or a mixture of these products through a multi-asset strategy or whatever as a fund manager, or you decide to specialize and be extremely good in one. I think that's one development that has happened and will sort of paint the architecture of fund management, whether you specialize or whether you become effectively a supermarket. Okay, and the other thing is, I think personally, I don't know whether other people would agree, but we have heightened regulation at the moment. I think more than 10% of our staff are either compliance, legal, or in the risk management divisions of our company. And this is doesn't convert itself immediately to profit. It's just an increasing expense. We had to have reserve requirements and make sure that according to the risk of our investments, we had to set aside capital in case things go wrong. I personally feel that as a fund management industry, managing other people's money, you can't afford to borrow. You can't afford to be in debt. It's too risky. You can get caught out and try and catch up and maybe take greater risks with other people's money. It's probably best always to remain, cash rich. What else did I have written down here? The other thing that's happened really since the turn of the century, or maybe since 1987, is the central banks and governments, when hit with an economic crisis, or quite often a market-driven crisis, they turn to two solutions, which is to flood the money with market via quantitative easing and bring interest rates down to zero. And we have got hooked on it. You would have thought that, if you're addicted to vodka, the best thing is to lay off vodka for a bit. Well, actually, the central banks and governments have decided that the only answer to stay in power as a politician, or if you're a central bank governor, the only way you're going to get through it all is to be very quick to switch to flooding the money with market flooding the market with money in order to survive. So this has led to an era of extremely low returns, and people having to scour the earth for areas where you can get at least a decent return. And at the same time, the baby boomers that Matt mentioned earlier are all getting to retirement age. Are they going to have enough money to retire from? Well, maybe not, but they're certainly an awful lot better off in this low interest environment than the Generation Y, Generation X, and the Millennials. I was just looking at a statement on the US that says that in terms of share of household wealth, Millennials have, oh, that's right, baby boomers have 60% of household wealth. The Generation Y has 3%, Generation X has 15%. There has to be some system for people who are just starting out in life to get a share of the growth in wealth of society. Otherwise, the whole social contract's going to go wrong. And you sometimes see it with all this, rich getting richer and the poor getting poorer. A lot of that's caused by these central banks. So all those things are in the competitive mix that affect the fund management industry. It's really difficult to predict where you are, but I think the priorities are A, listen to what your client wants, B, either offer many products and mixtures of them, or specialize in another one. That's really all I've got to say at the moment.
Thanks, Jerry. I think just to sum up, I think the increasing regulatory burdens, the new business models, and the new competitive patterns all coming together, this further compound the level of disruption in the industry. I think Jerry touched on a few points that we will speak about later. Now let us talk about the first few points that Jerry brought up. I think climate change. I think there is a challenging macro environment for investors now, where they need to find the right mix of return and risk combination. Now, in charting the strategic direction vis-a-vis in this evolving market landscape. Now, ESG or SRI funds across the region have performed well during the pandemic. Locally, I think even SC have developed the sustainable, responsible investment roadmap for the Malaysian capital market, or what we call the SRI roadmap, which leads to guide the efforts to accelerate the growth of this segment. So towards this end, SC also introduced the FIRE strategy, also to develop to facilitate the whole ecosystem. So findings from international studies have indicated that there is an increasing interest and demand for sustainable investment from retail investors globally. Maybe to my second panelist, your thoughts on this, Muzni?
Thanks, Matt. Really a tough one that you gave me on this, but I'll try my level best, just to say something about it and not make a fool of myself. Yeah, exactly. What a high standard Jerry has put on us. Never mind, it's okay. To start off with, let me just say that, in a recently published report by McKinsey and Company, which I think just came about a few weeks back, early part of October, I think the report was called, North American Asset Management Industry in the 2020s. It was suggested in that report that 8 trends have accelerated in the past 18 months, which will help set the horizon of growth for the asset management industry in 2020s, this coming decade. One of the 8 trends suggested in the report was the rise of sustainability and sustainable investing. So that's leading to the point that you just highlighted earlier. And in that report, it was stated that in the past 18 months have witnessed a major shift in retail investors' mindset. Sustainability is viewed not simply as an imperative of the corporate social responsibility or CSR, but also a critical consideration in capital allocation. All right, so that's a new thing now. So it's not just in the realm of CSR companies using it as a tool to say, hey, they've done well and they're doing good, socially, but investors are looking at it, shall I put the money where, it's doing good for the general society at large, okay? And now globally, sustainable investment funds stood at $2.3 trillion as at the end of first quarter 2021, having grown 26% annually since 2016. Now, what about Malaysia then? I think somewhere within the Securities Commission master plan, it is started. I mean, it was stated that SRI has similarities in terms of principle between Islamic finance and sustainable and responsible investment. Now, although I must say that Sharia and sustainable approaches to investing have developed independently, both have roots in religious principle, I must say. Of course, coming from Maybank Islamic asset management, I have to go to that part. Therefore, it is not surprising that the two sets of principle have high degree of overlap. Okay. If you look back at sustainable or responsible investment, it has existed, I think, as long as investing has existed. So now, for example, I mean, we did a bit of research together with some of our foreign partners. As long as in the 18th century, the Quakers, which is a group of religious movement which grew out of Christianity, barred its members from buying and selling slaves. So slave trade was a no-no for the Quakers, even though it was a commonplace at that time. Now, over time, sustainable investing grew out of its religious roots, gaining wider acceptance and tackling broader range of issues. Now, Islamic too emphasizes extensively on sustainable development, socio-economic justice, overall well-being and protection of the life, sharing of risk and rewards on an equitable manner, all of which is the hallmark of sustainable and responsible investment. I strongly believe that the similarities in the underlying principles between Sharia and sustainable principles, I mean, it may not be just Sharia. I mean, basically, religion is all about good conduct, good corporate governance, and doing good for the greater society. You know, it had helped in the broad acceptance of the sustainable investing in Malaysia by the retail investors. Now, just to share our own little experience in this part, you know, when we launched our Global Sustainable Equity I Fund in August last year, at first, right in the middle of the lockdown, at first we were unsure if the take-up will be even there. But we are pleased to say that, you know, after the first 1 month during the IOP, we've garnered several hundred millions to be exact on this, which is a testimony that investors took on the idea very well. Okay. However, I must say a lot more needs to be done in order to make this sustainable investment as a main pillar of investment in Malaysia. All right. For a start, I think standardization of the taxonomy and reporting requirements from the issuers. Okay. Investor awareness and investor education. Same goes with education towards the consultants. These are some of the key points that are needed to be addressed by the regulator and the industry players. And it goes without saying that getting a tax break from the MOF will do no harm to anyone as well on this front. Looking at the recent launches in Malaysia, I think if you just look at the past, I'd say 1 year, you see a lot of thematic and sustainable related funds such as technology, global multi-thematic, global energy, global sustainable, climate technology, biotechnology, supply chain, to name a few. All these are new investment ideas that are coming out on the basis of sustainable investing and responsible investing, which means all this investment idea, that means that investor education and distributor education is going to be paramount. All right. So I think in a nutshell, I think that's all I have on SRI. I can invite the rest of the members to chip in if they feel that there's something that I missed out. Over to you, Matt.
Thank you, Muzni. I think that was a good overview, but I think this is one of the areas of that I believe our Unity Trust consultants or those log in today needs to explore, you know. And I think from the pandemic, I think research have shown also the past results. This has also accelerated the ESG acceptance in Malaysia. Now, maybe back to another area where I think the recent pandemic has thrown many people and businesses into the deep end. So, no, I think the burning question is: has the role of an advisor or consultant changed? You know, and are there any emerging trends that you would think, you know, will carry on during or after the recovery? So, Bryan, over to you. But you know, what do you think? What skills are there needed for an advisor to remain relevant in the next normal?
Thanks, Matt, for that. Yeah, indeed, I think every one of us went through a very volatile 18 months or so, right? I think one of the things that we need to get used to in the future is definitely volatility, meaning to say that nothing's going to be constant anymore. we have been through volatility, like what Jerry has actually mentioned earlier, but things just get intensified over the past 18 months, right? Even government SOP can change by the hour. So these are the things that actually forces us as a consultant, right? We need to be very agile. Right, we need to be able to adapt to changes very quickly, and we need to be mobile as well, because our clients are also changing very quickly, right? Investment appetite, their focus, and even the work. When we talk about future of work, there's also another big topic about this. Talking about hybrid working from home, working in the office. The way that we work will also change in the future. So our clients are also impacted by this, and especially businesses as well, individuals as well. So these are the emerging trends that I definitely see. But as an advisor, as a consultant, largely our role, the key role still remains. For example, right, one of the main roles of a consultant is definitely to understand the client's needs and suitability of the product for the clients, right? This is still the key role of a consultant. Second thing is, of course, we have to navigate the field of the vast available products and solutions that's in the market. There are hundreds and thousands of funds and securities products, even in Malaysia itself. We are not talking about overseas, right? So how do you navigate this maze, right, of products and services? You need a consultant for that, right? And of course, reviewing the products, analyzing the product, making recommendations. This is also the role of a consultant that doesn't change across this pandemic. But clients now have high expectations on the services that consultants can deliver, and even to institutions as well, right? Clients now expect a greater range of tailored service, right? And I think Jerry also mentioned that tailor-made to the investors, and sometimes as an institution or as a consultant, we cannot do this on our own, right? We have to start making collaborations, partnership with different service providers. We have to expand our scope. We have to, follow the client's needs so that we remain relevant to our clients. And also, digitalizations, that's the buzzword for the past 2 years, right? Now, especially like today, we are meeting on Zoom virtually, right? Because of technology, we can do this conference virtually. So clients also are now getting used to virtual non-face-to-face meeting, a high adoption and utilization of digital tools, right, for their engagement. So I see clients are now expecting less and less, face-to-face meeting, less and less, meeting over coffee or over a beer or over dinner, right? People are finding technology is making them very efficient, right? We can have a meeting like this, without having to travel, without having to wait for the food to be cooked. It doesn't mean that we will replace all this, but the importance has actually become lesser compared to previously. Previously, when we go out and meet clients, right, our client expect us to meet them at their office or meet them near where they are. But nowadays, we can just meet for 15 minutes to do a quick chat, over Zoom or over the phone, or sometimes even while we are driving, we can still do discussion. So it has mixed things very, very at a fast pace. And as a consultant, we really need to adopt to it. So, the traditional office, I think, is no longer relevant. We are very agile right now. We are looking at paperless office. All this trend has been in place in the past 5-10 years, but it really, really accelerated, in the past 2 years. We are now talking about virtual office, where we can work anywhere. Everything is on the cloud. As long as we have a iPad or handphone or even a laptop, we can work anywhere. We can meet our clients. So our clients are also, experiencing this. And another point on sustainability, SRI investment or ESG for that matter as well, we also see the trend that, our clients are indeed very much looking at, investing, impact investing, right? Investing with a purpose, not just 100% about the dollar and cents returns, but clients have their unique sustainability goals, or rather their focus within the whole ESG or SRI, there are multiple, teams within that. So some clients are really into climate change, which is something that our firms believe in as well. Talking about decarbonization and things like this is actually a real thing. Phasing out internal combustion engine. We no longer need faster horse. We probably in the future there will be much lesser internal combustion engine, and everything is going electric, and it's really exciting. So these are the things that we see trends that's coming in, and really advisors or consultants really need to upskill themselves, and it's getting really a high demand on the consultants, right? A few things I may just bring up. In the past, to be a consultant, some of the skills that you need, definitely you need to have very good sales skills. You need to be very good in relationship building. You need to have technical knowledge on the products and services, and you need to do a little bit of business development. And with that, more or less, you are okay with your business. But in the next normal, or in the new normal, like the theme of this conference, advisors needs to have coaching skills, right? We need to be able to coach our clients, towards their financial goals. Time management, I find, is very key. Nowadays, when we work from home, we have to deal with so many conferences, Zoom fatigues, handling our family, children, running the errands, time management is really key, right? Business development as well, and because of so many products and services around, right? Even in the unit trust space, we are not short of products, right? There's a lot of data and analysis, so analytical skill is also very important. How do we analyze, right? This data that's coming in. Earlier I talked about collaboration. So teamwork and collaboration is also very important, because by ourselves, we cannot provide all the service that our clients need, right? We need to start to collaborate with other service providers, right? Strategic thinking, emotional intelligence, extremely important. Emotional health, right? Mental health is also a very key theme nowadays, right? How do you deal with stress? How do we deal with uncertainty? Becoming technology savvy, right? Learning to use all this new technology that we never touched before, before the lockdown, right? Technical skills and being good with numbers, that still remains. And I think last but not least is really marketing, branding, and social media, right? Because the competition is really fierce. How do you stand out? How do you get your clients, connected with you? How do you update your clients? How do you let your clients be informed? And how do you stand out above, all the other consultants in the market? Social media, nowadays people are going on TikToks and all these kind of things. It's really something new, and it has changed the landscape for us as a consultant. I think, these are a few points that I'd like to share, and I'll hand it back over to you, Matt.
Thank you, Bryan. I think we have heard it from on the asset management perspective, on the looking at it from the SRI perspective, No, but now we also, the last one that Bryan have just touched on, on advisor. Now, along the way, I think Bryan, Jerry, and the rest, Muzni, have also touched on a little bit on the clients. I like to call this the rewired investors. The rewired investors are referred to the new thinking patterns, the standards and expectation of this new generation of investors. This new generation of investors includes Gen X, Gen Y to investor, but also to baby boomers, which we spoke earlier on. Myself, Jerry and myself, we touched about, which will be influenced by the younger peers. So the rewired investor thinks and about advice differently, like Bryan just said just now, from previous generation, and expect to interact with their advisors in a different way. So the mentalities of the rewired investors allow me to sum it up, includes like digital and being personal, staying control, wisdom of my tribe, basically social media, they will check with their friends, do it yourself, anywhere, anytime. Now, my dear panelists, what is your take on these investment behavior changes, and how should the firm react? So, this question, who would like to share their thoughts on this? Maybe Gerald?
Yeah, sure. I'll give my thoughts, and I'm speaking as a a fading baby boomer. You know, I spent a couple of months in the UK, but getting there, filling in all the forms, making sure that my online application was correct, is something that I think, say, my parents would not be able to do. You know, technology requirements are pretty demanding for the older baby boomers, certainly. But one thing that has happened, a benefit of the MCO here in Malaysia, is that, you know, even people like me find it relatively easier to communicate with people by Zoom or MS Teams or whatever, and that is a definite positive to be gathered from the MCO. But my worry is that the younger generation, the millennials, Gen X, Gen Y, I don't know what the precise definition of these people are, but I think that's in order of age. Millennials are older than Gen X, who are older than Gen Y. Their share of the world's wealth is so low, and they're the ones that really need the help at this stage. But these low interest rates, you know, everybody's worried today about inflation. Some say it's transitory. I think the central bank governor of the US Federal Reserve said over the weekend that it was persistently transitory, which is a real sort of contradiction in terms. But I think that it's very important that I've lost my train of thought now. That these young people are able to get a share of wealth in the future. And one area, I know this is quite controversial for an old fogey like me, and that is by securitizing things. And securitization and slicing things thinner it can be done by blockchain, can be done by, you know, cryptocurrencies, actually. That is one means through which younger people can benefit from increase in asset values, because most of the older generation have benefited from these low interest rates and quantitative easing because they had the assets and the money in the first place. They're the ones that have made all the money, and that's just widened the gap between rich and poor. It's very important that the younger generation get a chance and get a share of it. And I think SRI and Islamic fund management are two key factors. I mean, the other thing I wanted to say that Muzni was mentioning, and that is that at least here in Malaysia, the ecosystem around Islamic finance and Islamic investing is very clear. You know what you're getting, and there is convergence of everybody's views on what is Sharia compliant and what is not. Maybe helped by the SC, but the education system, training, we know what we're going to get. It doesn't export so well. Here in Malaysia, we know what we're going to get. In terms of SRI, this convergence has not yet happened. You still get you know, various interpretations of what is ESG compliant and what is not, and the Securities Commission, Bursa Malaysia, the Ministry of Finance, Bank Negara are working very hard to get the taxonomy right and to make sure that everybody does converge. But that's another key part to helping the younger people.
I just saw, when you were speaking on that SRI in ESG, I just saw a question from the audience. Pretty tough one, you know, but, you know, clients today and in the past are more concerned about returns. How do we convince them that ESG offers good and even better returns? No, I think this is quite a common question, you know. And my first thought of it as a fund manager, I would say, look at ESG and SRI beyond returns. Look at it as more of a sustainable returns, you know. So what are your thoughts on this question by our audience? Muzni, you want to try this?
Yep, sure. You're right, Matt, in saying that, because yes, you know, one can look at returns, and if you are, classic example, you can punt into companies that are bad in corporate governance and make a ton of killing in a short time. But then, you know, as news develop and whatnot, then prices will come down. And if you did not time it correctly, you'll be making losses instead. So is that what you want? And from a fund manager's perspective, it is our responsibility to make sure that we don't go for such stocks. We look at longer term return, sustainable return. That is a correct word. Okay. And the principle is this: if you're doing good, then you should be making money over the long run. All right. Not to say that the crooks don't make money. Yes, they do make money, but yeah, in the next 5-10 years. But what is the legacy that you're going to give to your children? You're not thinking just for yourself now. When it comes to sustainable investing, it's all about legacy and legacy planning. You know, it's the wealth that you want to give to your children. Okay, is that something that you're going to be proud of? Is it something that is sustainable? Is it something that is going to be, you know, a legacy of yours? That's a short answer that I can give on that front.
No, I would agree with Engineer Muzni, but I would just also add this, that you remember when ETFs and passive investing started to come into vogue, I think maybe in the late 90s or during the early noughties, there tends to be a momentum as everybody starts to look at passive investment towards the larger, most liquid stocks with the biggest public float, because that's the way a lot of these indices work. And therefore, there was a natural rise in the prices of these stocks. Well, in the same way, I would say that in addition to being worried about your legacy, which is, you know, extremely valid and extremely important, there is a momentum in favor of ESG compliant stocks. That means that there's more demand for them. And if you, there are energy companies that also are taking into account the fact that they have to change and they have to transition to being new companies, and they will benefit. But those companies that haven't taken this into account their share price will underperform, and it affects their balance sheet. So what I'm really saying is that in addition to that legacy and making the world a better place, there is momentum that will lead to outperformance of a lot of ESG funds.
True.
Yeah, I agree with that assessment as well. I mean, Matt and the rest of the panelists, not everything it's about the returns, right? And there are many positive aspects to it. And the younger generation especially are actually very astute, and they want or they demand this kind of investments. Nowadays, even you know, I see a lot of young people when they come up to join a company or even to start a business, they are talking about social enterprise. How does their business, you know, be able to have a social impact on the society? And like what you know, Muzni has mentioned, you know, over the long term, you know, companies who practice good ESG principles does perform better in the long term. You know, we would have avoided things like, you know, the Evergrande saga in China, raking up too much debt and all these kind of things, you know, and climate change is, you know, now more and more countries, at least developed countries, are coming out, you know, to say that, you know, we want to reduce our carbonization, we want to, you know, be net neutral in their producing carbon and all these kind of things. So there is a massive trend that we see, and this is actually one key trends that I see that I'm getting our investors to go into as well.
Okay, thanks, Bryan. I think, Bryan, you hold on that. I think the next question is for you also, you know.
Really? Okay.
but I think because I think you spoke about financial literacy, right? So that there is a question that came through. In your opinion, should the consultant also play a role in enhancing financial literacy, as it naturally enhances trust for consultants and improve business? So you see, financial literacy all the while been, you know, they say it belongs to the firm and everything, but I think it's a collective effort across. So it's the same question to this, where with good financial literacy and then the understanding of risk and returns will help in one's portfolio. So what's your view?
Yes, definitely. I think it is a key point. Remember one of the point that I pointed out earlier, you know, as a new age advisor or to prepare for the future, right? You need to have coaching skills. So what does it mean by coaching skills? That you are able to coach your clients. So that is, you know, imparting financial literacy. Because you also mentioned, you know, the rewired investors. They want to have their wisdom of tribe. They want to do it themselves, right? They want to be in control. So how do they be in control? How do they do it themselves? You see, one key thing we realize is, you know, people, you know, what the pandemic, I mean, for the past 2 years, you know, people actually want to learn how to manage money, and they want to learn how to create wealth. And you know, we are in the best position, right, to help them learn this. We have to position ourselves as the subject matter expert, you know, as the nowadays they call, you know, financial influencer or whatever not, right? We have to be up there in the forefront. So it's not just nowadays about being a consultant, is not just selling products to our client. Is to let them be aware they have to take charge. We have to take up the role as the coach. We have to be able to impart, you know, knowledge so that they, the clients, can have can make an informed decision. That's my take on it. I think it's absolutely important.
Anything else, guys?
Yeah, Matt. Yeah, there's a point that you mentioned earlier with regards to shift in demography, and coming back to what question to Bryan as well. You know, if you realize in Malaysia, you know, the Malaysian population, you know, like the world, is fast aging. You know, people are living longer, birth rates are declining, and the aging society will lead to reduced workforce productivity and pool of savings, especially retirement savings. Now, this has resulted in two extreme propositions for the industry. One is, how best do we encourage private retirement savings for the future by enabling greater investment and risk-taking by the younger population? Voila, that is where financial literacy comes in play, and asking them to, you know, to start saving early and the likes of those. But on the other extreme, that which we always forget, is that how do we advise the retiring population to stretch their retirement dollar last a bit longer, okay, without sacrificing too much of the current lifestyle? Now, according to EPF statistics, I'm just looking at the latest statistic on 31st December 2019, EPF members between the age 46 to 55 holds almost 230 billion in savings. That represents about 34%, almost 1/3 of the total member saving in EPF, which means from 2020 up to 2030, this 10 years, on average, 23 billion will be eligible for withdrawal each year. All right. Now that represents a new segment of investors. Nobody ever targeted them, because we've always been targeting this EPF investment scheme for them to build up their retirement nest. Yeah. Now they're able to withdraw this money. Are we allow them to say, okay, spend all the money in one go, and, you know, that's it. After 5 years, all the money is lost. I think there should be a product that plans, that gives them a planning, a sense of planning on their money, stretching their retirement dollar. And I think SC is looking at this as well. And I think it should be timely that decumulation share class be introduced into the market. All right. Now, from a wealth management perspective, from a product feature, from an Islamic wealth management, and investors or consultants should be looking at not just trying to sell investment management product, but also advising on estate planning, advising on hibah, on tax planning and the likes of those as well. Okay, this is one area beyond just selling funds, but also advising them on those areas. Okay, so this is one segment I think consultants should look up, and if they've not done so already.
Yeah, I think that's a great point, Muzni. I think I've always been saying this, because the upcoming to transfer of wealth, and then there's the two demographic trends to this. So to sum it up is, wealth is about to change hand, and it's going to upset the established client-advisor relationship that is there. Now, I think I have one more question. I think it was highlighted earlier on. I think the famous topic, robo-advisor. All right, and I think I would call it science versus human-based. And with the rise of robo-advisors, there's a new combination of science and human-based advisory model have emerged. Now, how can one cope with the fast and ever-changing FinTech? Is it all robo, or is it going to be continue to be advisor-led, or is it going to be hybrid? So what I normally say to many of my consultants and everything, we are still in an advisory business. So what are your views on this?
I'll go first, Matt. I think you're right. At the end of the day, I think Bryan touches a good point. It's all about understanding the client's needs and the changing needs of the client. I believe in one thing. I mean, having done sales myself, your customer, our customer, don't care how much we know, but until they know how much we care. So it's all about understanding the needs of the customer. And that is one thing that Robo cannot do. They can advise you on risk, on product, on this, but hey, if there's an event that the customer need advice on, you know, on legacy, on tax planning, on estate planning, that is where I think the advice comes from a human being. Okay, so knowing the customer is key to the future. Okay, when I say knowing, it's not just knowing their birthdays, knowing their children, knowing what they like, their dislikes, and all those stuff.
Yeah, I would agree. Yeah, I mean, to be honest, I get lots and lots of emails and WhatsApps and SMSs around my birthday that are computer generated by a lot of these robo advisors or whatever, you know, trying to get close to me by realizing it's my birthday. I wish I'd reminded when it was my anniversary or my wife's birthday, but anyway, the long and the short of it is, I think it's very hard to navigate your way through all the different versions of robo advisors there are. And the way things normally pan out is there are a few big winners, you know, a few killer apps that win, and you've got to get the VHS rather than the Betamax of these types of robo advisors. I know that having a dominant position helps. I mean, Standard Life, with whom Aberdeen merged to form abrdn, as it's now known, in the UK, you know, we're very strong in the advisor section in the UK, and that's the way we think people are going to go. The responsibility for retirement savings has been turned off the employer to the individual now. And so it's liaising with them and making sure they have the right products. But I'm also a member here of a technical committee of a thing called the Finance Accreditation Agency. And if you look at the agenda for training somebody to be a financial advisor or financial planning expert, particularly an Islamic financial planning expert, you have to be a lawyer, you have to be an economist, you have to be so up to date. So it's a really, really tough job. So, you know, whoever does it, I hope they get well paid.
Yeah. So we really have to move up the value chain. I think technology is not an enemy. I mean, technology is a friend. I think technology is a great enabler, right? Technology should strengthen human relationship and not replace them, right? I mean, can you imagine if we go into the MCO without Zoom, without high-speed internet, you know, what will happen to our relationship with our parents who are staying away, you know, friends and colleagues, you know, we can't. And you know, like what we are doing right now, you know, virtual doesn't mean that, you know, doesn't have to be impersonal, right? We still can have a very cordial relationship, discussion about the topic, you know, even though we are meeting virtually. So the same thing it's applied to investments, right? With the advent of technology, the latest technology, it can help investment management to be very, very efficient, to be very, very cost effective, right? So we can outsource all our non-core work to technology, to robo advisors who can make decisions, you know, make calculations, you know, faster than any human being can do. So what we need to do is we need to make full use of this technology for the benefit of our clients. I think the investments trends, investments, you know, landscape has definitely changed. You know, traditionally, when we talk about investments, you know, suitability, we talk about risk profiling. You know, you do a set of questions and then we determine your risk profile and then we decide, you know, whether you're aggressive or whether you're balanced or whether you're conservative, right? I think that's no longer very relevant. Nowadays, we talk about, you know, how do we actually help our clients achieve their goal. So the risk of investment is no longer about the volatility of the security or the funds, but the risk for the client is whether he can or she can achieve his or her investment goals. Right, so the mind shift has actually changed, right? And also we no longer talk about how much money you want to invest, or you know, when we meet client, we don't talk about, you know, how much you want to top up this time, but we talk about why do you want to top up your investments. So it's now the conversation has shifted, you know, to the why behind the what. No longer centered around what product advisory, you know, robo advisors that you should use, whether you should invest in crypto and all these kind of things. But, you know, the whole holistic advice, you know, to help the clients achieve their financial goals. And I do like to believe, you know, the pandemic has actually accelerated this mind shift, right? Every one of us, you know, I've seen a lot of people suffering, and they now find that, you know, financial literacy is really, really important. Last time, when we're doing our CFP and our training, and all our lecturers tell us, we must have at least 6 months of emergency fund. And after this pandemic, we know probably you need 2 years, right? And I also believe a lot of people right now, I would tend to think they would be very risk averse going in the future. Remember, I mentioned about uncertainty. There's a lot of uncertainty going ahead into the future. When there is uncertainty, naturally investors will be very risk averse. We would really be diversifying our investments, looking at securing, preserving the assets rather than chasing after the latest trend. I mean, that's my take on it.
Yeah, thank you very much, Bryan. I think I will spend a couple of minutes now just to summing up a couple of the points that was discussed today. Since there's no other question coming through. Now, I think for most of the audience, our unit trust consultants, I would always say unit trust consultants are like entrepreneurs. So basically, you're starting a business that should be able to test the test of time. Unfortunately, it's not as easy as it may sound, because considered trends are always evolving. Things like customer habits we spoke about and expectation are bound to change from time to time. So it also means that it will help if you have a business model can withstand the test of time, which often means having a steady, reliable business. So you must be, your focus should be getting ahead of the curve. So robo advising, we discussed just now, is still far away. It's still far from replacing humans completely. But indeed, like Bryan said, most of its operation within asset management or investment management are confined and controlled by some form of human supervision. So consequently, a better way to describe this is a collection of techniques that will automate and facilitate part of the practice of investment management business. So it helps to make it more efficient. So this is a time of significant change and disruption for the industry. So there will be new forms of advice and new ways to deliver the advice will continue to emerge. So a competitive position will erode and others will strengthen. So creating winners and losers across the industry. So here are some of the lists of takeaway from some of the panelists that I would like to just summarize here to take away to future-proof your business. So don't depend only on one part of your business for complete success. You must think of other ways to diversify your product portfolio. Like that's now what Muzni have said, Bryan had talked about, that you should be looking at a complete thing like, even to extend will and trust, wealth planning and all those type of things. Now, secondly, rethink your past strategies that may fail to engage the new customer. I think that's now early on, Gerald started off, he spoke about, car, I read it somewhere that where you got here won't take you there. This simply means that the strategy that you use to acquire your existing base of customers may not be useful to acquire new customer in the future. So your old strategy may no longer work and you might struggle to acquire new customers. So you need to adopt to the new way. Now, predict the future demands. So when I used to use this quote, Henry Ford used to say, make cheap and reliable cars. Now, what's wrong with the horse? That was a huge bet you make and you work. So your customers can't always tell you what they want. You have to anticipate it. So this needs some imagination and experience with the trends that we work in for both the firm and also as a consultant. Now, we spoke about customer behavior. Listen to your customers and observe their behavior. So in order to future-proof your business, you should start focusing on the changes in customers' behavior that might happen in the near future. So also earlier on, we talked about the future demands, ESG, SRI is something that we may want to look at. Now, the fifth one, follow the trends in the developed countries. Talk about, I think this is one of the easiest of all the other strategies to stay ahead in the game. You must regularly track what's happening in other developed countries also, and what's going on, all these things will be influencing or watch out for those influence factors surrounding your business. If you really want to future-proof your practice, I call it a practice, you need to keep an eye on your surrounding. You must make yourself aware of the developments happening around you, even those are not related to our industry. So things are changing fast in today's business scenario, and even a successful business cannot guarantee survival if it's not prepared for the future. So you can future-proof your business to some extent and stay ahead of the competition. So I hope I did not miss out any point, but I will go around around my panelists to maybe have a few final advice or words to our audience, how they could future-proof their business.
I think, Matt, you're right in one extent. To one extent, when things are going really well, you tend to take your foot off the pedal and stop thinking about how the world might change. And I remember there was a time when Aberdeen was doing particularly well. We had a couple of real successful flagship products, and you're a bit like a fly on the motorway, and then suddenly things change, circumstances change. I think it was the first taper tantrum that affected us. Suddenly, those killer products just liquidated. And it's like, on a fly on a motorway, you get hit by a windscreen and it's over. So you have to be always thinking about what's going to happen in the future. Yes.
Muzni, any final thoughts?
Yeah. Technology is definitely an enabler. It is a tool for us to use. But I would like to remind all of us something. If that is so, then automotive engineers will be the best car salesmen, but in reality they are not. You can go and bombard the customers with product highlight sheets with all the technical specification and all the return and all the stuff, and they will say, do you have it in pink? So that's the whole idea. Salesmen or consultants need really to understand the client, and that is key. Technology is there, use it, embrace it, but it's the human emotion, the touch, that is very important.
Yeah, thanks, Muzni. Is a very good analogy there. And if you have it in red, it actually adds 10 horsepower to it. Yeah. So for an advisor, I think we have to be conscious to always rethink our strategy. One question I will leave to all advisors or consultants here is, ask yourself this, what's your value proposition? Well, what value do you bring to the table to your clients? Why would your client choose you as their advisors? So these are very, very relevant questions that, we constantly ask ourselves as well to stay ahead of the game, right? We have to anticipate what our clients want, what their aspirations, and how do we, come into the play and continue to be relevant to our client, continue to add that value to our clients. I think that's utmost important.
That's good. Now, I thought I was going to wrap up the session, but I think we have two other questions that just pop in. All right. Interesting question, but I think it's quite a common question. I think to be fair, for those who have taken the effort to key in the question, let's try to address this. EPF and enabling digitalization of its platform is a good move for investors. It's a consultant. We should shift to a more advisory service fee roles instead. So I think let me maybe put this question manage this question a bit. I think basically I understand this question basically saying that should we be moving to a more advisory and service fee roles, with EPI digitalization. But I think my first take on this is digitalization is happening not only on EPF, but it's on everything that we do on a day-to-day basis in our industry. So, like we mentioned just now, one needs to diversify your product portfolio. So it's something that the panel has been speaking about, Muzni, myself, or even Bryan, or even Gerald. We spoke about, you should look beyond your portfolio, or even different asset class, multi-asset classes, things like that. That will, and that will help in your overall practice. I use the word practice because to me, unit trust consultant is a practice. You advise your people for unit trust. If you go one step further, you move on to advisory. You become a certified financial planner, and things like that, or a financial advisor. So to that question, maybe I'd like to add on, and Muzni or Bryan or even Gerald.
Yeah, I mean, I agree on that, with regards to digitization and EPF. I think the industry has been overly reliant on EPF money, and sorry to say this word, but pushing the EPF product a little bit too far. Now the EPF have lowered the fees and whatnot. End of the day, I think as a consultant, as an advisor, the key word is still giving advice, and the right advice to the right client. So it's not just one strategy fits all, but each client have a different, needs and wants that you have to understand. Okay, so yep, diversification is still the way forward, and not just look at what we already have, but complete the whole package when it comes to advising. Okay, and it's not just looking at I did mention estate planning, tax planning, all those stuff, but also if you go back and look at the entire life cycle, when your investors are young, what will be their need as compared to investors are already in the 50s? The needs are different. You need to really understand them and advise them accordingly.
All right, I'll add on to that. I think as an advisor, as a consultant, we really need to move from being transactional, right, to a more holistic advisory role. Our clients, will never go back to the thumbprints, once they've tasted the digital investments. It's so easy. You can go into multiple fund style, and you can invest, during that for 3 months time period. So there's no going back to that portion. So the thing is, we need to upskill ourselves and see how do we do the other stuff that computer can't do. Like what Muzni actually mentioned, yes, before this is, invest in unit trust potentially can give higher returns than EPF. So now we have to ask the question, by having this potentially higher returns, what does it mean to the client? When would you start withdrawing your money? Muzni mentioned about, decumulation products. How do you structure that in your client's portfolio? And what happens to the tax aspect? What happens to the estate planning aspect to it? There's so many other things, so many conversations to discuss around, rather than just being somebody who helps our clients to invest in EPF funds, right? Yeah, that's a very good, summary to that.
Yeah, I would say, just for my own penny's worth, that Malaysia has sort of hit the ground hard over quite a short space of time. I think when I first came here, which was a long time ago, but people invested in equities or invested in mutual funds in anticipation of them doubling in a week. And if they put money with Amanah Saham Bumiputra or the EPF, they expected to get 10% income every year, absolutely guaranteed, without really knowing how capital markets work. Well, with the change in the ways the developed world central banks are working and quantitative easing and zero interest rates, they've realized, I think last year's payments of income for EPF and a lot of the PNB unit trusts have shown that reality is hit, and you have to rely on compounding. So don't blow everything that you've got saved, because if you keep it there, the beauty of compounding is it gets bigger and bigger and bigger. Now, obviously, the MCO has dealt a very heavy blow to a lot of people's EPF savings. I understand Puan Rahaya of EPF said the other day that the withdrawals so far under ICNA and the other methods you can take money out of your savings now has gone to 100 billion ringgit since the three systems started in, was it June 2020? Mm-hmm. So there is a real shortfall in people's savings here, as there is all over the world. But, the PRS is one way of adding to your savings with tax advantages as well. That's something that I don't think has really gained enough momentum here in Malaysia.
Thank you, guys. I think it's already 11:12. I think we have overshot our time. The last question that I have, my apologies. I think one or two questions that we are not able to address now because of the short of time. But basically, it's on financial literacy. Shall the consultant convey or push the public? I think we have mentioned over the last 1 hour. People now there's a different breed of investors. They are the thirst for knowledge and everything. Always remember, be transparent, You know, be transparent with the client. You know, share with your clients, and look beyond it. You know, it's not something that you don't look at it as immediate gratification, but for future gratification, it's a long-term relationship. So that is very, very important. So on that note, my apologies if you could address some of the other questions, but thank you very much. You know, it's been an honor, and thank you to all the panelists for your time. And I wish everyone, the audience, the best in your practice. And have a great day. Thank you, panelists. Thank you. And have a great day. Enjoy the rest of the conference. Thank you very much. Thank you, guys.
Thank you.
Thank you.
Thank you.